G'day folks, welcome back to another update for Bitcoin and Ripple. Now they're still both bearish in terms of their trends, but just there is a minor bounce in the charts. We'll cover that in a minute. We're going to also include some back testing. Before we go any further, make sure you hit that like and subscribe button to support the channel, but also reference the +1 videos where we look at a deeper dive into various trading strategies. I won't read through all of this, but you can pause the video and read it through yourself in time. But basically, spot Bitcoin ETF approvals and ongoing large 2025 inflows underpin institutional demand, and fresh flow this week showed Bitcoin ETFs netted plus $330 million. For XRP, automated market maker shipped in 2024, legal case closure and penalties reported by multiple outlets, secondary market clarity referenced widely. So looking at Bitcoin first, we always look at the long-term trends, and here on the weekly you can see the price is just touching that moving average band and it's pulling back towards that Fibonacci retrace. And for those new to the channel, these moving average bands can be found in links in the description below and learn how to draw them on your own charting software. And the reason I use bands is because you'll notice here, instead of using a single moving average, when they consolidate and they start bunching up, that shows consolidation of the price versus nice price movement like they were back here, for example, in these uptrends. Same applies for the CCI down here. Now what we've happened here with the CCI in declining highs versus higher highs in the price, that's a bearish divergence, and what we do is we measure a Fibonacci retrace. Just blow that up for a moment. We measure a Fibonacci retrace from that high and we go back to the previous low before that divergence started, and that would have been that point there. And that is our minimum target. That 23-38% is a minimum target range. You can see it's only a few points away from that range at the moment, touching that moving average range. So that's why I've drawn these rectangles. So that's on its way of meeting the divergence target. And the way we read that as well is when the CCI drops below the moving average range. And again, you can see a very tight moving average range there. The price hasn't actually constricted yet, but that will likely hit that range in the coming hours or days at least, possibly. So that's the bearish divergence on the weekly. If we go to the daily, similarly, we did have a bearish divergence back here that fell off and that broke through our target range. We had another smaller one here, and that looks like it just missed it at that point there. They don't always work, but more than 90% of the time these little retraces work. Now, this is currently in a downtrend on the price and the CCI, but notice the CCI is broken into that moving average range. So you would have been going short during this period and you'd be closing out your short positions once that hits that moving average range on the CCI. And that shows an earlier exit on that candle rather than waiting for it to hit the moving average band of the price band. So at the moment, bearish to neutral positioning on the daily chart. We also look at the 1 hour chart in this case for any micro moves. And by micro moves, I'm talking about even if you're trading on the daily, you see if there's any moves on the smaller time frames to look out for. And what we're looking for is a divergence. So you can see here, generally back here, the highs and lows of the CCI moving in tangent with the price. Until such time we get to this point, you'll notice here we've got higher lows to that point versus lower lows on the price. And that was just after our last video update. That's a bullish divergence. Now you can trade these, but I don't. Again, when I'm going short during these periods, when the price and the CCI are in a decline, I'm going short. And I avoid going in a long position. Why? Because we always go in the direction of the higher time frame. So if you're trading on the hourly, always trade in the direction of the higher time frame. So you would have traded these short positions and avoided going long. So where we are at the moment with the 1 hour time period, you also take notice of these bullish divergence, and you would have ideally closed out your positions, your short positions, somewhere around this period once it broke through and that divergence started to play out. And that's what it's done. Now you'll notice here as well, in terms of a Fibonacci retrace, again, we'll take it back to that minimum high. You can see there it's already broken through the 23-38% range. It's even gone higher than the 61% range, coming close to the 100%. But even if we took it back to that high, you can see there it's already broken through that 23-38 and currently sitting around the 50% range on the Fibonacci. But just to keep it simple, take it back to the recent high before the divergence started. Now if we go to the back test, here we've got the 1 hour chart and the daily, as I said, taking the direction of the daily. So you would have taken short positions once the price broke below the moving average, and so was the CCI. And that's marked here on the 1 hour chart. And you would have taken short positions. Now what it's done here, it's you always pay attention to these divergences, see little bullish divergence there. You would have got out of that position there. And entered these various trades. Now again, going short in this case when the price and the moving averages of the CCI1500 are in the downtrend, but also wait for the CCI14 here to break to the downside to take a position open. It also averages down, and you can do the average down process, and here it's averaged down once, a single trade there, another single trade there, average down another one there. But had you let it play out throughout the whole period, and again you would have closed out any positions at the very latest at that point there when you see a bullish divergence. This has generated about $4,000 in revenue since the 18th of August. So here we have Ripple. So on the weekly first off, you can see there the price is above the moving average, giving us a bullish momentum there. But notice we've got this long-term bearish divergence with the CCI dropping off strongly. So what we do now is we've already started that and see it's already pulling back. So we draw a Fibonacci from that high. We'll take it back to that low there, significant low before that divergence started. And you can see there it's already hit the 23-38% range almost instantly on that bearish candle there. So let's draw it from there. So on that bearish candle there, it came down the second week after that divergence completed, with the CCI still dropping off, and now it's the CCI is below the moving average range. The price is still above the moving average, but the 23-38% range has been hit. It may possibly bounce. It could go anywhere from here, could bounce, or it could drop further. So what we do now is we look at the lower time frames to get a better idea of what the micro moves might be. So this is the weekly. Going to the daily, again, you would have gone short from that period there when the candle broke below the moving average range, and so did the CCI. That would have been short positions only, and you'd be closing out very closely. If not, let me just see if that's hit the moving average range. So you'd be closing out your trades at the very latest on that candle currently on that today. So at the moment it's bearish momentum only for Ripple. On the micro moves on the 1 hour chart, again you had a couple of bullish divergence here. That bounce hit our targets, and more recently again notice there we've got a bullish divergence, higher lows on the CCI versus lower lows on the price. We take it back to the same point. That one there came down to the same period. If that was lower, you would have extended that trend line to that point there, and that would have been a continuation of a bullish divergence. And what we do now is we draw a Fibonacci on that. Let's take it back to that high before it started. You can see there it's already pulled through the 23-38% range, currently sitting around a 38% range. But even if you pulled it there, it's still higher, just a very minor change. So looking at the 1 hour chart here on a back test, we're trading $5,000 lots of Ripple. So again, going short from this period when the price and the moving averages break below their respective moving averages. You can see there, again, we had those bullish divergence. You would have been watching it carefully. As soon as you started seeing the price break high, you would have closed out your positions. In this case, they were very small trades anyway during that period. But if you let it run through the whole period, again, noticing the bullish divergence here where we are at the moment, you would have closed out your positions once you started seeing that bullish divergence playing out, which would have been around about that point at the very latest. You probably would have had a contract open, but that still generated some nice little returns had you had let it play throughout the whole period. So hit that like and subscribe button to support the channel. That would be greatly appreciated. If you enjoy the content, subscribe at least on a free trial to my Patreon page where I publish weekly bullish shares across various regions of the world's markets. Thanks, and talk to you in our next video.